So guys, overall it was a pretty solid month for the stock market. The S&P climbed around 7.5%, putting it back in the green for the year. But even with that rally, there are still corners of the stock market that are moving in the opposite direction. And in this video, we're going to look at 3 stocks that continue to slide and I think are worth looking into as we jump into June. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. And also guys, if you want to keep track of how all of my stock picks in this video series are performing, I put together a free public scoreboard where you can see everything all in one place. This spreadsheet tracks how all of my stock picks have done since mentioning them in these videos. And if you want to get access to the spreadsheet, just click the link in the description of the video or in the pinned comment. So for a long time in the comments, you guys have been telling me to look at EOG Resources, and I know it took me long enough to get there, but I'm so glad that I finally looked at this company because it looks really solid and the share price has seen quite the pullback this year. Now, in case you've never heard of EOG Resources, this is an upstream oil and gas company that makes their money by exploring for and producing oil and natural gas. So we can see from the map here, most of their operations are here in the United States. And what sets EOG apart is their focus on being one of the lowest cost and highest returning producers. On this topic, Morningstar wrote, EOG's capital allocation strategy sits somewhat alone relative to other U.S. exploration and production players. While the consolidation bug has bitten its peers and the integrated majors, EOG principally focuses on organic exploration efforts. And like other U.S. exploration and production peers, EOG has embraced a capital allocation policy that emphasizes returning cash to shareholders, yet retains a willingness to invest in modest production growth. Finally, in an industry that overextended itself during the shale revolution, EOG pivoted sooner than most in becoming a low-cost provider. So that all sounds pretty good, but even with all of that going for it, EOG's share price really hasn't reflected a lot of the strengths behind the company lately. Taking a look at the share price performance over here on Snapstock, which by the way, guys, we are working hard behind the scenes to make some serious improvements to Snapstock, and one of those is going to be making it its own standalone thing. Previously, to get access to Snapstock, you had to become a member of the investment club, where you got some other perks as well. But like I said, pretty soon we'll be opening Snapstock back up and you can just get access to this platform and nothing else if that's what you want. And I don't have an exact timeline for that yet. I'll definitely keep you guys posted. But if you want to stay up to date, you can join the waiting list. There's a link to that in the description of the video. So definitely check that out. But anyway, guys, getting back to EOG Resources, in the last month, it's not been too crazy. It's only down about 0.8%. But if we zoom out looking at EOG's year-to-date performance, it's seen quite the drop. It's down about 12% here in 2025, and looking over the last year, it's down almost 8%. So another drop here as well. But with that, if we scroll down looking at some of these valuation stats here, we can see the company has a very low PE ratio sitting at just about 10, so just barely there in the double digits. Nice and low PE ratio, and with that, their free cash flow yield is on the up and up, currently sitting at 9.1, which is way higher than the company's 5 and 10-year average free cash flow yields. So all of that's to say that the valuation could definitely be worse with EOG. And with that, if we look at the Snap score right here, guys, we can see we're getting a very above average company. The Snap score is coming in at about an 8 out of 10. And looking at the breakdown, it's scoring really high in pretty much every single category. Growth is solid, profitability is perfect, debt 8 out of 10, really like to see that, and very strong dividends and capital efficiency scores as well. And taking a closer look at some of these, just getting into the growth category right here. Generally speaking, looking at the trend here on all of these charts, revenue, earnings per share, and free cash flow per share, we can see that they're more or less all up and to the right. We definitely noticed that here in the revenue chart. We certainly see that here in the earnings chart here from 2017 on to 2023, with the exception of 2020, which we'll give them a pass for. Everything was up and to the right. And once again, we do see a nice upward trajectory here in the free cash flow per share. So over the years, they're definitely growing in all departments, which is great to see. This is exactly what we want. And along with that consistent growth, EOG also looks to have a pretty clean balance sheet. They have a net cash position, which means they have negative net debt, which means that they have more cash than debt on their balance sheet, which is a great thing. We don't have to worry about EOG going bankrupt anytime soon. And if we scroll down just a little bit more looking at the dividend department, things are looking great rate here as well. We're getting a nice yield coming in at about 3.3%. And along with that, we're getting a very high dividend growth rate, both over the 5 and 10-year periods. We're seeing over 20% CAGRs. And I know that this chart here looks a little bit wonky. We see some big spikes here from 2020 to 2022, and then it kind of dips back down here. But what this is, guys, there was a period here in 2022 and 2023 where EOG was paying special dividends almost every quarter. And as we can see, these special dividends in many cases were actually considerably larger than their regular dividends. So that explains the wonkiness in that chart there. But moving on, guys, looking at the payout ratios here, this is looking to be fantastic. In 2024, the earnings payout ratio was only about 32.6%, so plenty of room to continue paying and growing that thing, very well covered. And the same is true here with the free cash flow payout ratio, which is actually even lower, coming in just above 30%. So overall, I think there's a lot to like about this company. I actually ended up adding EOG to my watch list, so I'll be keeping a closer eye on it moving forward. And at today's prices, I definitely think this is one to consider. So this next company, A.O. Smith, is another one that I've never talked about before here on the channel, but it's a great looking company. It's very easy to understand, and it's a pretty boring but definitely necessary business. In a nutshell, A.O. Smith is a manufacturer of water heaters and boilers, and they're actually the largest player in a very concentrated industry. According to Morningstar, there are only 3 major companies that dominate the water heater market. We have A.O. Smith, Ryne, and Bradford White, and together they control over 90% of this market, and of those 3 companies, A.O. Smith holds the top spot. And taking a look at the share price performance, this one's seen a bit more of a drop than what we saw with EOG a moment ago. In the last month, AOS is down 4%, and if we look at the year-to-date performance, it's down, really not too much more. It's down only 5% this year, but if we zoom out looking at the performance over the last year, it's really seen a steep pullback. It's down over 20%. With that though, if we scroll down looking at some of these valuation stats, this one's going to come with a very low PE ratio at 17.94, so almost 18. This is a bit higher than what we saw with EOG a moment ago, but still this 18 is quite a bit below the 5 and 10-year averages. And with that, the free cash flow yield is looking pretty solid too, about 4.3, which is right in line with the 5 and 10-year averages. And with AOS, we're getting another very high quality company with a snap score of about 7.5. And looking at the breakdown, they're scoring pretty high in almost every department. Profitability is going to be the lowest score here, but still 5 out of 10 is not bad. We got some solid growth, perfect debt, solid dividends and buybacks, and very strong capital efficiency, which means very strong returns on invested capital. But anyway, if we scroll down getting into some of these growth stats here, like with the last company, revenue, earnings per share, and free cash flow per share are all trending up and to the right at pretty decent rates as well. I mean, over the last 5 years, revenue's grown by about 7% on average. Looks like earnings per share has basically doubled that, which is great to see. And over the last 5 years, the free cash flow per share growth rate isn't anything crazy, less than 1%, but over the last 10 years, it's about 8.5%. So that's looking pretty promising. And then guys, just scrolling down a little bit more, getting into the debt situation. Like with the last company, AOS has a net cash position, which means this company is holding more cash on their balance sheet than debt, which is fantastic. This is one of my favorite things to see in a company. Not that debt's necessarily a bad thing, but when you see a net cash position, I think that the debt situation is just, it's one less thing you have to worry about. And to me, it adds some more resilience to the company, which is never a bad thing. But anyway, now scrolling down, looking at the dividend stats, with AOS, we're getting a yield just above 2%. So not the highest yield, pretty moderate yield, I would say, and also a pretty moderate 5-year growth rate of 7.3%, which is about half the 10-year average growth rate of actually, it's exactly half as I'm looking at this right here, 14.64%. And while the dividend growth has been pretty consistent, and for the most part, I would say has been respectable, we do notice that the growth rate is slowing down over the years. Every single year, the growth rate looks to be getting a little bit slower. So that is one thing to keep in mind when it comes to this company. But if you're okay with, a mid to high single-digit growth rate, I think this one is still in your wheelhouse. And with that, the dividend still looks to be very well covered. In 2024, they had an earnings payout ratio of about 36%. And looking at the free cash flow payout ratio, this was a bit higher at 40%. But either way, like I said, that dividend is very well covered, and they're doing a great job of buying back shares. Overall, AOS has a lot of the qualities that I tend to look for in a business. We've got growing financials, we've got negative net debt, and we've got a growing and well-covered dividend. And like with EOG, I also added AOS to my watch list, so I'm excited to spend a bit more time with this one. Now guys, this third stock is one that I'm sure we all know very well. FedEx is one of the world's largest logistics and delivery companies, and I honestly don't think a day goes by that I don't see a FedEx truck driving around. At any rate, getting right into it, looking at the share price performance, as opposed to the previous two companies, FedEx has actually seen a pretty nice gain in the last month. The stock is up almost 6%. So pretty nice jump there, but if we look at the year-to-date performance, it is down a lot still. It's down almost 20% just here in 2025, and if we look at the last year's performance, it's down about 10.4%, so another drop here as well. And then with that, if we scroll down looking at the PE ratio and the free cash flow yield, the PE ratio right here is pretty low, 13.6, which is below both the 5 and 10-year averages. So based on these numbers here, it looks to be a little bit undervalued. And I would say the same is definitely true here looking at the free cash flow yield. So 5-year average is 3.6%, 10-year average is about 2%, but right now the free cash flow yield is 6.4%. So that's looking pretty good to me. But the thing about FedEx, guys, is it actually has the lowest snap score of the day, coming in at 4.6%, which according to this makes it just an average business. We've got an average growth score here, 5 out of 10. Profitability is very low, which is actually no surprise since FedEx is a pretty capital intensive business. So I wouldn't hold this against them too much because it just comes with the territory. But anyway, debt's a 4 out of 10, which it's actually not that bad. I'll explain in a moment. Really solid dividends and buybacks and very low capital efficiency. But anyway, let's look a little bit closer at all of this stuff, guys. So starting with the growth, it's been a very consistent grower. Looking at this revenue chart, for the most part, it's been straight up and to the right ever since 2022. Looks like sales have kind of flattened out or even declined since then for the last couple of years, but still nothing too terrible. And it looks like the earnings per share has been pretty solid as well. 2019 and 2020 were rough years, but if you exclude those, the general trend is up and to the right, which is fantastic. And then getting into the free cash flow per share. Now, this is where we see the most weakness. 2017 to 2020, pretty rough years for this company's free cash flow, but they came back very strong post-pandemic. And since then, the free cash flow per share has been on the up and up. It's been a lot higher than even the pre-pandemic levels. But anyway, scrolling down, taking a look at the debt situation, just as a reminder, they scored a 4 out of 10 here, so not a great debt score. And as we can see here in 2020, they really took on a lot more debt. Their debt actually doubled year over year, and right now the debt's coming in at about $32 billion. So at first glance, it looks very high, and the net debt to free cash flow is about 10. So yeah, definitely looks high, but I will say it's not as bad as it seems. A big chunk of what shows up as debt on this company's balance sheet are capital leases, which are the long-term leases they have for things like their trucks, their airplanes, all of their buildings that they use to operate their network. And in fact, as we can see here, capital leases make up almost half of the company's total debt load. So when you take that into consideration, I don't think this debt situation is as bad as it seems. But anyway, scrolling down a little bit more, taking a look at the dividend stats, we can see we're getting a moderate yield, about 2.5%, with a very solid dividend growth rate here, 20% on average over the last 5 and 10 years. And actually, looks like the growth has picked up in recent years. 2022, we had a 16% growth rate. 2023, it was 54%, almost 54%. And in 2024, it came back down into the single digits, but still very high, 9.5%. And if we scroll down, we can see the dividend is very well covered with a 30% earnings payout ratio and a 42.7% free cash flow payout ratio. So not worried about the dividend being cut at all. So with that, guys, I think FedEx is another solid contender if you're in the market for another great dividend growth stock. And I think the same is true for all 3 of the companies we looked at today. With that, though, those 3 aren't the only ones. There's still quite a handful of other stocks out there that I think you need to keep your eye on. The first of which, guys, is Booz Allen Hamilton, ticker symbol BAH, which has seen a big drop in the last month. The stock is down 10.4%. We can see it really jumped off a cliff right here just about a week ago, actually. And if we zoom out looking at the year-to-date performance, the stock is down about 20%. And then, guys, we've got Chevron. I know a lot of you guys out there have been picking up some shares of Chevron. In the last month, the stock is actually up a little bit. It's up 1% basically, but looking at the year-to-date performance, it is in the red. It's down almost 6% so far for the year. And then jumping over to the consumer staples sector, I also think General Mills is a good one to keep an eye on. In the last month, the stock is down about 4%, so a nice little pullback there. And if we look at the year-to-date performance, so far it's down about 14% for the year. But anyway, jumping over to this next one, this is one I actually have in my own portfolio. This is Lowe's. In the last month, Lowe's is up a little bit, 1.7%, but still so far for the year, the stock is down almost 10%, and $225, that's not a terrible price for Lowe's. So I think this is a good one to keep an eye on. But anyway, moving on to this next one, you guys are probably sick of hearing me talk about Old Dominion, but I still think it's one to consider. It's had a really solid month, actually. It's up about 9% just in the last 30 days. But if we look at the year-to-date performance, the stock is still down 10%, so I don't think it's a bad buy. And also, this happens to be a very high-quality company with a snap score of about 8. And I mean, look at that, guys. The scores speak for themselves. This is a very high quality company, so definitely one to keep an eye on. But anyway, moving on, this next one is Pool Corporation, which I either talked about in last month's video or the one the month before that, I don't quite remember. But either way, I think this is a good one to keep an eye on still. It's up a little bit in the last month. It's up about 4.1%. But if we look at the year-to-date performance, it's still in the red here. It's still down about 10.5%. But anyway, moving on, I know a lot of you guys out there are buying this one. This is probably one of the most, if not the most popular and talked about dividend stocks right now. This one is UNH, who just can't catch a break. In the last month, the stock is down 26.5%, and looking at the year to date, it's down almost 42%, and in a very short amount of time. As recent as April 11th, the stock was at $600 per share, and now, about a month and a half later, it's less than half of that. But anyway, my friends, I also think ExxonMobil is a good one to keep an eye on. In the last month, the stock is down 3.4%, let's call it, and year to date, it's down about 4.8%, with a pretty high free cash flow yield coming in at 6.2%. But anyway, those are all of the stocks that I think are good ones to keep an eye on right now. And if you want to hear about 3 more stocks that I'm most definitely staying away from and suggest you do the same, then check out this next video right over here. In this one, I'm telling you about 3 dividend stocks that many investors like to buy, but truth be told, these stocks are terrible investments and you should avoid them at all costs. So click right over here to find out which ones they are, and I'll see you in the next one.